This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the data sets and doing a quick technical analysis over the SPY and TLT slash doing a small economic macro talk. Sorry if you can hear my daughter screaming, by the way. And that's for December 5th, 2025. And with that said, let's go ahead and jump straight into the data. I apologize for no video yesterday. I've been sick with pneumonia. It doesn't sound like it, but it continuously comes and goes. It's like my lungs will just randomly fill up all of a sudden. But yeah, let's kind of just go over all the data. So on Wednesday, we obviously had the ADP come in very, very, very weak. It was all over the news. Everybody was talking about it. I was extremely surprised the yields didn't absolutely melt over that one, but it's ADP. That's I forgot the exact uh it's automatic digital process or data processing. Um that's why the market doesn't take it as important as like the BLS numbers, which that's the continuing or the jobless claims numbers. Um that's why the market today had a lot more of a reaction compared to yesterday with the numbers over the ADP. Now, we did have full export and import prices. That was something we talked about. We had an expectation for that. The global composite and global services PMI came in cooler. So that was something we talked about. I didn't really have an expectation on that one way or another though. The ISM non-manufacturing data overall came in slightly cooler, but the employment number did go up slightly. But it's still in a contractory set of numbers. As long as it's below 4 or below 50, then it's showing contraction. Okay. Um, the non-manufacturing PMI going up kind of fully anticipated that. We expected the prices to go up, very slightly. Now I'm going to kind of counter what I just said because the price is showing a little bit of downside in that aspect. But with the PMI, it's kind of pricing in the whole thing. So anyway, we did have the jobless claims today. They did come in pretty good. They showed a little bit of a pullback compared to those higher numbers that the market was really anticipating and expecting. Now, I won't go into a whole you know, conspiracy theory stuff. Uh, these numbers are pretty good. Um, but we really do need to see the PCE data. That's really going to tell the story in terms of the labor market because we have multiple different stories going on. We have the BLS showing some weak numbers, but obviously as of this week, those are a lot stronger. But are those still strong numbers? No. Those are still not the numbers they're looking for, but obviously they are a lot better than what they were expecting. The PCE is very important. It's the Personal Consumption Expenditure Index. So if we see prices go up in the PCE tomorrow, that's going to be very bad for the yields, meaning that should pull the yields up quite a bit. I know that we have TLT positions, and that will actually go against our TLT positions if we see the PC data come in hot. However, in the long run, that's showing that um, the whole stagflation uh, process of what our whole thesis has been is currently in effect. And we do fully anticipate that. We've been talking about that for a while now, that even though we're not really expecting prices to increase, we're expecting prices to slowly start coming down. And a lot of these producers are still going to be having to price their stuff upward, even if the consumer really can't afford it. So as much as we might see some upward quote unquote inflation, I'm not really counting it as inflation because realistically, it's going to come back down. Um, Consumer data has been coming in very weak, and that will show that a weak consumer cannot buy products. Okay, we're seeing factory orders and everything else coming in much weaker. So it is showing a slowdown. Okay, not as much as some might want, but it is showing a slowdown. Okay. Now, the inflation numbers tomorrow, I really do expect these to come down, as they are kind of the 1 year and 5 year rate. Um, Perhaps we see the 1 year come in at 4.5%, but I really do expect the 5 year inflation rate to pull down to the 3.3, even potentially the 3.2. The consumer expectations, they are showing a higher consumer expectation for the forecast. However, I disagree with that from everything I've been hearing from local retailers and just what I have in my communications, that so far Black Friday sales have not been the greatest. Cyber Monday sales have not been the greatest. So we have not been seeing the strongest numbers um from, these events that are really supposed to be some of the largest selling days in the year. So it is a problem, and it will really affect a lot of jobs come January. I really do think we will be seeing the jobless claims picking up, because one thing we do have to keep in mind with the jobless claims, those are only for people that are applying for any form of unemployment, um, anything like that. Some of these people that are currently being laid off or um, taken out of the workforce are completely quitting the workforce. Now, I know that doesn't account for all the numbers, so don't assume that, but that does account for a chunk of the numbers. A lot of people currently right now are having a very hard time getting rehired. So when we see the jobless claims and everything not going up exactly, uh, one thing we can look towards is the unemployment rate, because generally the unemployment rate and the jobless claims will go hand in hand. And I know that the unemployment rate has been ticking upwards slightly. So very, very likely in the grand scheme of things, we will see the jobless claims go upward. I'd be very, very surprised if we see that head downward. And to even kind of push that narrative forward a little bit more, the Atlanta Fed GDP came in today a little bit weaker. And again, this was at 4 point something percent. Okay. Uh, they were expecting a lot more growth than what we're getting. And I really think a lot of the companies, retailers, and everybody, once they start providing the numbers from this season, and once they really start seeing how much money they didn't get, um, the head counts will shrink, and very, very likely unemployment will increase. I could be wrong about that, and I'd be completely fine being wrong about that. But I do really see a lot of signals that are pointing towards the recession narrative. So I am kind of on board with that. Uh, I know some people think it's crazy when we have tech and AI going absolutely nuts, but the thing is that all that money at the top isn't reaching the 99% of people. Um, the 99% of people still hold up the economy in the end. Unfortunately, it can't just be the top tech companies. It has to be the taxpayers. And the taxpayers aren't getting any of this rally other than through their retirements or, the funds from work and everything else. But it's not like people are getting massive pay increases, because we've been looking at the weekly and monthly pay data, and it has not been increasing over time. And if there is slight increases, generally the companies that have increased those, didn't actually increase their wages at all. They just simply reduced headcounts of people who were more expendable. Um, which in the end reduces the or increases the hourly wage. So I'm seeing a lot of recessionary signals. Uh, I know that there's a lot of different narratives going on, and there is some strength in the market. There is some strength in the economy, but we have to look at the whole picture. And will the 1% top tech and the Mag 7 bail out the 99% of people who need money? No, absolutely not. Will a $2,000 check from, the United States bail out the vast majority of people? Absolutely not. Um, Very likely that money would go straight into the market. And, because people that are struggling generally want to find ways to turn their lives around. And how do you do that other than the market? So, yeah, I don't think that's exactly a good thing. I think that would be very bad for the market, and we did see that a lot in COVID. I know I kind of said that I would do the macro discussion later in the video, but guess we kind of stumbled into it. Um, so going over the data tomorrow, okay, getting back in focus. Tomorrow, 10 a.m. is really a very, very, very key time slot. That's 30 minutes after open. That's literally when 90% of the data comes out tomorrow. We have the Atlanta Fed GDP at 11, but as you saw on Thursday, it did pull down slightly, so there should truly be no change in that number at all, unless there's some really absurd reading from the PCE. Other than that, there's really no data in the day that's going to move the market. Now, there is the October consumer credit coming out, but that's pretty much when the market's already ended for the day. So if that is super dovish or something, then that's going to hit Monday. Or, the Sunday market, early morning Monday, and potentially carry over to then. So that can be a very important data set, but I wouldn't be worrying about it too much. If it's going to be a big data set, we have the whole weekend to prepare for it. So, yeah, really, it's that 10 a.m. time slot. I wouldn't be worried too much about that Atlanta Fed GDP moving the market. That could pretty much pull down to about 2.4%, and I don't think the market would really have a major shift from that. So, it's something to keep track of, but I don't really expect anything to, you know, move the market too much from that aspect. But a lot of this 10 a.m. data is super, super important. If this PCE data comes in cooler, then you're going to see the yields absolutely melt and you will see the market fly. Um, if these 1 year or if the 1 year inflation data expectations come in weaker, then the market is going to absolutely fly, okay? So it's a very busy day tomorrow, as from a data aspect, but I did kind of want to cover the macro side of things too, because I didn't get to post a video yesterday, and there has been a lot of data between, Wednesday and the jobless claims today and everything. And again, looking at the factory orders, I know that's kind of off topic at this point, but um, we talked about we've been talking about orders all week, and the factory orders came in today super, super, super low, almost at 0%. So still heavily supports the thesis that we're seeing a slowdown. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. Getting into the technical analysis, as always, let's go ahead and ensure our daily time frame is turned on and turn on our moving averages and Bollinger Bands. Now, getting straight into this, we have been pretty much sitting on the 5 mile moving average the last 3 days now. And we talked about that on Monday and Tuesday, how we expected the upper side of the 5 mile being tested as of Friday, and we were looking for the lower side of the 5 mile being tested. Now, because they didn't pull down the market yesterday, we now are sitting in the position where the 5 mile has now climbed back up to basically towards the level we're at now. Um, because remember, it only takes 5 trading sessions for the 5-day moving average to pull up to the level you're at. So when we've been essentially trading at this level for 5 days, we now have the 5 mile moving right on top of us. Now, I will go into structure in just a minute here, but I do want to cover all of the moving averages first. Now, we do have the 10 mile slowly pulling above the 20 mile, okay? So currently, we now have the 5 mile above the 10 mile above the 20 mile, and the 20 mile above the 50 mile. This is so far very, very bullish, okay? This is positioning the moving averages so they're positioned all for the upside, meaning none of these moving averages are intertwined. You don't have the 10 mile below the 20 mile. You don't have anything below each other. You have the shortest moving average above the next one and the next one, so on and so forth. So currently we are primed to head up quite a bit. Okay. Heading up from here really only leaves one level, and that is the upper Bollinger. With the upper Bollinger being at 692.85, a move from the current range, and we're just basically going to call the current range 685 because the overnight is currently trading at 686. So we're going to assume between the early market, the pre-market data and the overnight session and everything, we're just going to call the level 685. If it goes above or below, then, compensate for that in your strategy. But with that said, okay, a move from the 685 to the upper Bollinger right now, just in terms of the chart, is a $8 move. Okay. Now, when we have an upper Bollinger move, generally you close at the level or above, meaning with the upper Bollinger essentially being at 693, you should be expecting essentially above 693. Okay. With the upper Bollinger mechanics, being back tested and holding true, we know that the day two generally pulls a higher high, meaning if the prior session was expecting a 693, then, we can possibly expect a 695, 696. If they really, really push it, then maybe the 700, but that's really, really pushing it. I would say the 696 would truly be the limit. However, with the structure we have right here, and this is where I'm going to pull up the drawings and turn off the moving averages for a moment. And let's turn off the Bollingers for a second because you all will see the point. I mean, obviously you can see the cup and the handle on the screen. We now have this cup and handle playing out very well. And as long as the data tomorrow doesn't cause us to heavily pull down, and even if we do heavily pull down at this point, we have now started to really test the top of the selling channel, and we now have the 5 mile basically pulled up. Excuse me, I'm still sick with my pneumonia. We basically have the 5 mile pulled up into the top of this selling channel. So the upside looks very, 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 very likely from here. Okay. With that said, we're just going to keep the selling channel there for a moment. We're not going to move it right now because that was the previous selling channel. If this is going to build a new structure to head downward, then we will, determine that at a later point, okay? But the current structure says we have this very, very strong cup, and that was completed as of yesterday's trading session, Wednesday the 3rd, and as of, or no, not yesterday's session. That was, the prior cup completion. Okay. And we have the prior cup completing. It did not fully complete at this level, but going over the 4-hour time frame, it's very hard to not look at that as a cup and handle because you do have the liquidity of an additional cup and handle right there. So that looks like a very strong cup and handle. With that said, it does look like this cup and handle is going to break us out of the selling channel with some real conviction. It looks like the upper Bollinger range will be pushed. So with that expectation, and if you've been listening to my posts over the last few days, you would be set up in tech straddles, um, and those would be doing very well. Now, the expectation should be really that 695. Now, that's assuming we have an upper Bollinger move as of tomorrow's trading session. So that's assuming the PCE data comes in very cool. The market prices in not only the December rate cut in further, it's currently at 87 or 88% of chance right now. Um, but not only will we see the December rate cut priced in further, but we will also see the January rate cut priced in further as well. The January rate cut, I believe, is currently at 27%, somewhere around there. So it is very elevated. Okay. Especially for it being a whole, essentially 2 months out, month and a half out, something like that. Um, yeah, the structure looks very good for the upside. Okay, with the upper Bollinger above us, with all of our moving averages below us, I'd be very, very surprised if this market or if this move does not happen in the market tomorrow. Now, with that said, there's always the possibility of the news coming in bad tomorrow and us having a very large rejection. Okay, what we have to look for is if we have, a rejection, one, does it go below the 5 mile? And if it goes below the 5 mile, is it going to start heading towards the 20 mile? Okay, and the way we'll know that is checking the lower bounds of the 5 mile. So assuming the 5 mile tomorrow is basically going to be around the 683.80-ish, give or take. As we did close at 684.39 today. So again, that will be pulled up very slightly. But assuming that's where we have that, um, the lower bounds of the 5 mile will be at 681, potentially 680. And that means that if we start testing the lower bounds and you see the VVIX moving upward, pushing towards that 98 range or higher, then that's going to be telling you exactly what you need to know. And that's saying that, yes, we are going to be rejecting the 5 mile and heading to the 20 mile. If you don't see those exact symbol or, exact signals, then the upside is truly where the market's going to be heading right now. That's why we did extend that prior buying channel down to the support at the 650.85. We did talk about that in Sunday's video, where if we did see this selling channel start to be pushed against, that we would extend the buying channel down to that support, because obviously it's showing that it's continuing the buying upward. Okay, so that's the SPY analysis for now. Another thing I want you to take a look at though really quick is the ADL. And again, for those who do not use this indicator or don't know what it does, it's basically like a bank account. If you see it going up, that means money is going into the symbol. If you see it going down, then money is being withdrawn from the symbol. Well, we have a ton of money being put into the SPY right now, which means that overall tech, overall semiconductors, everybody's having money pushed into it right now. So that's pretty bullish for the market, seeing how all the other prior ranges we had to really complete some major rejections. We did not see those rejections occur. And at this point, what really is looking to be created is the very, very large cup closure all the way up to the 690. And from the top of that 690 range, and I'm going to delete this cup and handle here for a moment. And this cup is arbitrary in terms of the structure. I know that the channel's a lot closer to that. We'll do that. That'll make it easier to explain. Remember that once we do reach the top of the cup, that we are looking for a bearish structure at the top. And this bearish structure can be very misleading. It can look kind of like a straight line, but we are looking for the bearish structure at the top, bullish structure at the bottom, and for this larger cup to create the liquidity to push higher. And that's how we will see the 710, 715 plus range. Okay. That's not for a couple weeks out, but this is how we get the liquidity to do so. And with a lot of these bullish structures being completed, it looks extremely strong heading to the upside. The only bearish thing we have right now is the fact that we still have a gap right there of about $6. Okay. If we see rejection at that range, so for example, if we have a massive rejection tomorrow off of the news, then that potentially could break us out of this bullish structure. Okay. This cup has not been fully completed yet. And until this larger cup, and I'm looking at that structure right there to complete that structure. Okay. I know that this smaller cup has been completed. We have the structure right there and the structure right there. So you know it's been completed. Okay. I'm talking about the larger cup. Now, if this larger cup is to be completed, you do want to see it completed all the way up to that 690 range. Um, Anything lower than that is really not what you're looking for to be bullish. Okay. With that said, that is going to be the SPY technical analysis. I just want to take a very quick look over the 4-hour chart just to see I'm not missing anything. Now, it looks very well prepared to head to the upside. Um, Unless data or tomorrow's data shifts it, I'd be, again, very surprised not to see that. Now let's go ahead and talk about TLT. And very quickly going over TLT, um, there has been a massive bond sale going on since Monday. Got the name of the firm. It's Merck and Company, if I believe. But they've been selling, I believe, $14 billion worth of corporate bonds, which have heavily been pushing upward against the 10-year treasury yield. Also, we've been having Japan, or the Bank of Japan, they've been talking about increasing the interest rates on their end, which we will talk about in Sunday's video. That leads to a whole massive trade blow up, and yeah, that's way too extensive for this video. But we will go into that in Sunday's video. But that's kind of the whole carry trade unwinding thing. I don't expect that to happen yet, but we know that the BOJ is going to be doing a 25 basis point rate hike come the 19th. Now, the FOMC is doing their decision on the 16th, so we're going to have our FOMC do a 25 basis point cut, and then the yen, or the BOJ, do a 25 basis point hike. It's going to make the yen carry trade very, very tricky to maneuver for many firms. So that potentially can be very, very bearish for equities. And If that occurs, that's going to cause TLT to pull up quite a bit, but we have been having some very, very large entities selling bonds. Okay. Can't really shy away from that. It's within the charts, it's telling us very clearly. We've been having extremely, extremely dovish news, and TLT and the 10-year yields and everything have not been moving in the way that I expect at all. Um, does that mean that the thesis is wrong or anything? No. It just means that there are a ton of people shorting TLT right now. Its short interest is actually at an all-time high, which is very, very kind of surprising, especially when we're just about getting ready to do a rate cut. Um, Very surprising to see. But we've been seeing a lot of selling within the treasuries. Now, it's hard for me to, how do I word this? It's hard for me to really quantify from a technical perspective how to maneuver that because one, we see the bearish structure here. That bearish structure tells us that likely we're going to see selling downward. Okay, if we don't see the data tomorrow pull this up pretty quickly. Um, that tells us that we're very, very likely going to be selling all the way down to this 87 range. Okay, that 87.17. We do have some support at the 87. Sorry, I want to get this down to the right cent. Basically, the 87.50. Um, if we do hit that range, then that could be a very, very large potential bounce. Let's take a look at some of these prior support ranges. Now, one thing I do want to say is that even though we have been having a lot of selling, we have an extremely obvious inverse cup and handle formed here, which again, that is a bearish structure that's very, very likely telling us we're going to head downward. However, this consolidation channel has been holding up like a champ. It has not been breaking. We've been having some reports that pull the yields up, and it still has not been cracking this. We've been having very, very large firms and government entities selling bonds, and it has still not cracked this consolidation channel line. So thesis is still either we're going to have a major bounce very, very soon here, back up all the way to the 92. That's where the top of that channel was prior. It's just saying the 91.53 due to the dividend, but we will see the cup close all the way back up to the 92. This will form a very large double bottom, and then we will head upward in that channel. Or we're going to finally see this consolidation channel break, and we will head down to that 87.17. And from that 87.17, with how strong this buying channel has been, very likely that's where we will see the bounce. So, how do we kind of maneuver the contracts and everything? If we don't see the major bounce off this bottom consolidation line, then you do need to get out of those December contracts. Okay. Am I still bullish for the end of December? Yes, I am. I think that the economic conditions are really, really heading towards putting a ton of weight into treasuries. It's a very, very close time frame though. We need to really be focusing on the March contracts, which they are the March 31st 96 calls is what I've been personally taking. They have been taking a little bit of a beating, but not too bad so far. I'm only down about 12% on them total. I have not had to add to them very much at all, but that March timeframe will really solidify a lot of the um, financial conditions that will push bonds upward further. And that's the holiday sales will be over. So if we're going to see the unemployment and everything really pick up, that's the time it's going to happen. That's the time you're going to see the headcounts, shrink drastically. You're going to see the unemployment heavily increase, very likely. Um, so the March timeframe really aligns very well. Um, it gets us through majority of the first quarter, and again, the 97 strike is very within our reach. Okay. Um, with that said, I've still been taking the 90 calls for December 31st. I do have a plethora of other calls as well, but the ones I've basically been adding to is those December 90 calls. Um, if we get our gap filled, then those 90 calls are going to be very much in the profit and then some. So, looking to use those as a way to kind of mitigate some of the loss out of the previous contracts when we did have the whole government shutdown for a month and a half. Now, with that said, if you're really concerned about downside, and personally, I'm not, okay, and that just has to be a decision you have to make as a trader. But I'm not worried about the downside from here. I see where the economy is going. I see where kind of everything is headed in the grand scheme, and I'm very confident in my position. But if you're not confident in your position, if you are worried about, you know, possibly having those calls burned, buy a couple puts. The put range is very good because either we're going to have that big bounce or we're going to pull down. Well, we have a whole, um, you know, almost dollar and a half range that we can shed on the downside still. Um, Potentially more if some of the conditions actually line up, which I have not been seeing yet, but some of those puts could pay out very well. If you're truly worried about the upside not paying out. So having a couple of those puts for the same duration, just as a hedge, is not a decision that I would say is bad. I would say that that would be a very good decision for the most part. Especially like targeting this 87 range. The real thesis is we are going to have that massive bounce or the pull down. So either the calls are going to pay out massively, or they're all going to burn, and you're going to see the puts pay. I believe the puts are super cheap, so no reason not to grab a couple and can easily save or even profit from any of the prior losses from entering those earlier contracts. But thesis still stands. I still stand heavily by my thesis as well. Um, I see all the upside. Okay. I've been reading a lot of the comments, not just in like, Webull and everything, but some of the Bloomberg, uh, you know, uh, write-ups and more of the bearish thesis on why people expect the yields to pull up more. And I see their thesis a lot. And one of the main points for their thesis is that the job market is changing and that we truly don't need all these jobs. Well, sure, that's fine. But people need these jobs. People are still very much real and they still very much exist. So they still need a job at the end of the day. And not everybody's able to get retrained into these fancy AI jobs. Um, Unfortunately, we have many generations that grew up in times when the computer was just being invented. Um, let alone AI and everything else. So it's unreasonable to ask people to have to relearn their entire life. Okay, and that's the real bear thesis on TLT, is that are we going to see a job or a labor market where we truly don't need people anymore? I don't think that's how it works. You know, call me stupid, but I think that you need people in a labor market to have wages, to be consumers, to spend money, to um be a part of the society and be a part of the economy. So yeah, I don't see the downside in bonds right now. I think that there's a ton of economic risk, and with that economic risk being very, very present, a lot of this upside can be shed very easily. And we're still not out of the woods of this economic or this collateral condition either. Uh or this collateral crisis. Sorry, I can't talk. Um the DXY is still elevated even though we did break out of that 99 range, uh, close to that 100 range. We are still at the 98.99. It can pull back up very, very quickly. I believe we even had a few days where we saw a whole 75-cent movement on the DXY. So if that carry trade starts unwinding, if we start seeing some companies or firms or everything start wanting to take profit out of some of the tech, then potentially we can see this really start to pick up. Now the SOFR rates have been still elevated, but we have not been seeing the SOFR being used in the in a way where it's super super concerning, but it's still being used above average. And still being used above average at the upper bounds of the Fed interest rates. So with the interest rates being cut and everything else, that really suggests that the collateral is going to tighten even further and that people will need to borrow, continue borrowing against the Fed upper limit. So we'll see how that goes. I just want everyone to truly be safe with these TLT positions with December. The government shutdown really threw a wrench in those positions, and I'm not happy about it, but I am still bullish on TLT overall, and hopefully my thesis is clear. I believe I am on the correct path with it, but I'm always willing to listen to other opinions and everything else. So if you have a different opinion, feel free to share it. But yeah, I'm very bullish on TLT. Um, with that said, I'm going to stop rambling. Going to end the video here. I hope everyone has a great night. Have a great weekend, and I will talk to you all on Sunday. And trade tomorrow's data very carefully. It could be very tricky. So, yeah, I will talk to you all Monday or all Sunday. Thank you for watching. Take care. I appreciate you all. Thank you.